Favorite motivational quote?
You miss 100% of the shots you don't take. A great difference with like real estate as opposed to like stocks is the fact that you can use leverage, right? And you can put, $100,000 down on a property and get a bigger asset versus stocks is you put 100,000 in, there you have 100,000 worth of stock. That ability to use leverage, couple that with depreciation, because now my depreciation is based on the total asset less whatever is allocated to land. So you get to take depreciation on the bigger asset. So there's a lot more nuances in the tax code that are favorable. It's also written to incentivize investment in real estate. So there's built-in advantages to it.
Well, hello, everyone, and welcome back to the Eddie Austin BEX Show. I've got a really cool dude on the day. His name is CJ. He is the real estate CPA. He is known in the real estate world as your tax professional, the one that keeps you in the saving the money that you make. And he was a guest on our Game Changer community. Absolutely blew the top off of it, and we're ready to hear some more. So CJ, man, thank you so much for taking time out of your very busy schedule around this time of the year.
Thanks so much, Eddie. Really excited to be here. Excited to chat with you, and I'm happy to see where the conversation goes.
Yeah, absolutely, man. Let's jump right in. So what got you into doing CPA work? Like, what was the bug?
Yeah, so I think, really the origin story was I took an accounting class in high school, and for whatever reason, it just clicked with me. I think a lot of people have the understanding of if you're good at math, you'd probably be good at accounting. Not necessarily. I think at least with what I do now, it's a lot of critical thinking and like thinking outside of the box, right? So everyone's situation is different. It's how can I apply the certain aspects of the tax law to my client's situation? So took that class in high school, and that kind of stuck in the back of my mind. And then when it became time to choose what I wanted to do, I pursued an accounting degree, and then kind of just kept taking that a step further. Got my master's in tax as well, and then got my CPA license, and just have got an incredible amount of knowledge and value in the profession.
That's so cool to hear that somebody else loves numbers, but they took it a step further. Like, I went a different direction with numbers, but let's talk about that for a minute. So is it really that it takes patterns in that strategic thinking to really build the best plan? And I would assume that there's no one size fits all, is there?
That's exactly right. So I think it takes a level of repetition of just, before I started my own firm, I worked for a decade at large CPA firms and worked with CPAs that have been doing it 30 years. And I think in this profession, it really takes a lot of repetition, seeing different things, working through different, client scenarios, having someone that's been doing this a long time that you can ask and pick their brain and strategize. And I think you kind of see the patterns. I think you are able to see, after doing probably over 1,000 tax returns at this point, what results clients got different from others, right? The ones that planned and strategized, their results were different than someone who just, hey, I'm going to just drop off my documents at tax time. It is what it is.
Mm-hmm.
So yeah, there's no one size fits all. It really takes someone really diving into your situation and figuring out what are your goals, what levers can we pull that align with those goals. And that's kind of the baseline of the strategic planning.
Absolutely. For me, just thinking through all the different phases of life that I've been in, and, every season had every level was a new devil, right? And there was definitely lots more planning that went in. Like, we would long file, when I was still employed and doing the side gigs, and you had all these separate returns and everything else. But there was a phase when you would start to exit bigger portfolios. Like, before you dropped the hammer on that, like, you reached out to your CPA and said, hey, we're about ready to do X, Y, Z. And the way that I thought that we should do that was completely different than the way that we actually did it. And it was really because we had good guidance. And, so talk about how you've been able to guide certain clients, because like, there's two different scenarios I think that we commonly get confused on, is difference between like real estate professional and non-real estate professional, and the different tax benefits, because both of them have different benefits, But some of us can't reap all those benefits if we're not a real estate professional.
Yep, yep. So a lot of good points there, a lot of good things we can unpack there. Yeah, I think as a best practice, it's always best to reach out to your CPA proactively before you finalize any decisions. That's where we can add the most value, right? There's only so much you can do retroactively and correctively. It's really giving that guidance in real time to say, hey, don't structure it this way because of X reason. So I have situations come up like that all the time where clients will give me a call, hey, I'm thinking about buying this property. I'm going to do it in this entity. And then I can tell them, hey, either yes, go ahead, or no, don't do it because it has this adverse impact. So always on the front end, you want to be able to reach out. And then just to follow up on what you had mentioned on real estate professional versus not being one, it really goes in line with like the passive activity loss limitations, which came into play in the 80s. Basically, when people would just, high income earners would go buy real estate and then pay no taxes. They put these rules in place to make it a little bit more difficult to achieve that result. And really, the way around that is being a real estate professional. And what the criteria for that is spending at least 750 hours for the year in real estate activities, and then more time in real estate than anything else that you do. So that starts to eliminate a lot of people that aren't in real estate full time. And that what that does is give you the ability to now have losses be treated as non-passive instead of passive. Why does that matter? It's because passive activities can only be combined with other passive activities. Passive losses can't offset active income.
So let's dive into that real quick because I want to give you two separate scenarios. So scenario A, I'm a high net worth tech individual. I'm accredited. I'm making my $300,000 a year. And I decide that I'm going to invest in Dan's multifamily syndication. It has 100% bonus depreciation. I do go to conferences and I don't own any current real estate. I care a lot about my job, and I'm just taking all this money that I've made and I'm investing it into this asset. Can I actually get benefits? Like, can I write off my active income with
So
where I stand?
in that scenario, I think you do get benefits, but it's not. Let's unpack what that actually means, right? So, in that case, you would likely be a passive investor. Not to say you don't get benefits, right? So, with your active income, that gets taxed fully, right? There's if you're a W-2 employee, there's not many deductions and write-offs and things of that nature that are going to be applicable to you. Whereas that investment that you make, often there'll be depreciation that's associated with that investment that's going to offset the rental income generated. So essentially, you're getting this really tax favored situation, and you're able to start shifting your active income into real estate and grow your wealth that way. So although it may not be able to offset your W-2 income, it's still a great place to be tax favorable.
So as you earn back from this investment, that could be deemed as active income, passive income coming back, correct? But yet we could depreciate some of that because of the depreciation in the asset.
So your the income generated would be technically passive in this scenario. And then what happens is that income gets offset with depreciation. A lot of times that'll be done in methods that we can unpack of accelerating depreciation to even provide even more benefit. So that passive income is being offset with a tax item such as depreciation so that you're not getting taxed on it. So you're getting your money back from that investment, but you may not be paying tax on it because of depreciation.
I see.
And there's always with all these things, there's so many nuances. There's only so much we
Sure.
can cover.
Sure.
And then there are the ability to, if you do have an overall passive loss that maybe you can't use against active sources, maybe you have passive income somewhere else that it can be used against. So there's just a lot of planning elements to it, but just wanted to throw that out there.
Yeah. And I think the reason for going in on these questions is, I'm a real estate professional. All I do is real estate. So I've had to navigate through these things. And every time investors call me up and say, hey, I got this big tax problem. I want to do XYZ. Talk to your CPA. because they are 100% different than what I am. And I can definitely give them the playbook on what I do. But however, that may not be applicable or be able to be applied to what they're doing. So it's not good for me to say, yeah, man, you just do X, Y, Z and you'll be fine. And then they're like, hey, I'm getting audited. And, that's not good. So scenario B is more in line with, okay, I own a business. I own rental properties. I take care of those rental properties. I have it all documented on my calendar. I'm a real estate professional. I'm going to take the money that I've made in my business and I'm going to invest $100,000 into this. And it's giving me $100,000 bonus depreciation. Same deal. There's 100% bonus depreciation because they did a cost seg. And what does that look like for me? Because I'm already a real estate professional.
So in your scenario, it would be an investment in like a fund or a syndication. So that's where you would want to be looking at is if you can group that under, because you still need to participate in the real estate in some regard, right? So there are some limitations there. So it would be a matter of really looking at your situation a little bit more deeper and seeing, hey, is there a way we can group that in to achieve that non-passive result? And like I said, I think it always comes back to the best advice you can give someone is speak with your CPA and have them go through your situation in detail. And that's why with new clients for us, we have a pretty detailed like discovery process where we meet with someone, really unpack their situation, get a sense of is there value we can add? Is there levers that we can pull to help them with? So that's just kind of another way of saying you need to dive a little bit deeper into their situation.
I love the way you answered that because so many times somebody has questions on real estate, taxes, stuff like that, and they send them a YouTube video. They're like, hey, just watch this video. This is all you need to know, and just do this and you'll be fine. But that's not true. And, one of the things that I wanted to really dive in on this podcast was exactly this subject is to emphasize on not everybody's created equal. Your situation is not equal. Your income, your taxes, like there's so many things like this is tax planning. And the only way to properly plan is to build that plan for you. And, it is not a one size fits all. It's not like you go to YouTube, you watch one or two videos, and then you call up your fly by night CPA and you're like, hey, we need to do this, this, and this. Like you need to go to the best, most educated CPA you can find. I would highly recommend CJ. And you go through that onboarding process and you go through that introductory and find out the discovery of, yeah, I have rental properties. I'm a general partner on this deal. I'm 100% passive because then you can really project out the next 5 years. Like, what's this look like? So when is these exits coming up? I think that's
Yeah. And
another
I
thing
think,
that's powerful, right?
yeah. And I think, really with that, not only is it really fact specific for you, but it's also kind of projecting out what are your goals, right? So a lot of the things we do now, if we're not really understanding your goals, they could be recommendations that may be not favorable a couple of years down the road, right? So we do want to have an idea of where are we going so that we can make recommendations that are in line with that now. So I just wanted to throw that out there as well.
Absolutely. I think that's the thing you got to get here. Everybody listening is this is planning. Like not only you're planning your life, but you're planning retirement because you're saving on the taxes. Of course, you're 100% making money right now. You're doing good things, but there's so many things you can do in alternative assets that also have tax implications and also tax benefits. And what would you say about that is somebody starting out, they're investing in stocks or they're thinking about real estate investments. Is it a good idea to reach out to somebody like yourself and say, hey, I'm heavy in stocks right now, but I want to move heavy into real estate? Because look, as we all know, at this current time, stocks, gold, silver, bonds, like everything's soaring like crazy. And let's say that investor's like, hey, I'm thinking that I want to remove my liability, my downside risk over here and put it more into an active real estate. What would be the proper path for that?
Yeah, I think it's really, unpacking that more. So I have clients that kind of vary across the spectrum, right? Some clients that if they have another dollar, they're going to figure out how to put it into real estate, and then some clients that are a little bit more diversified, right? So I think it's just explaining to them what the advantages and disadvantages are, and then diving into their situation a little bit further. For example, one benefit, and how I think is largely from a tax perspective, but I do always throw out that it still has to align with your investment criteria. That should be the primary lens you look through, and then kind of layer in the tax benefits secondarily. It should never just do something just to chase tax benefits. Uh, so a great difference with like real estate as opposed to like stocks is the fact that you can use leverage, right? And you can put, $100,000 down on a property and get a bigger asset versus stocks is you put 100,000 in, there you have 100,000 worth of stock. So that ability to use leverage, couple that with depreciation, because now my depreciation is based on the total asset less whatever is allocated to land without getting too technical. So you get to take depreciation on the bigger asset. So there's a lot more nuances in the tax code that are favorable. It's also written to incentivize investment in real estate. So there's built-in advantages to it. And that's how I would, kind of go through that and strategize a little bit more, just provide some education. And then from there, kind of go what makes sense for you if you want to go down that path.
Absolutely. And we're going to go heavy on real estate during the next 10 minutes here, guys. And, I'm not trying to talk you out of it. And I shouldn't say that because maybe I am. I've never really invested in stocks or crypto or blockchain or anything like that, mostly because I've never had anybody explain it well enough to me that it made sense. I didn't understand how it works. I don't think anybody should invest if they don't understand how it works. But here's the reasons that I think that real estate is the best investment on the planet. And I want my CPA here to talk back and say, Eddie, you're either right or you need to think about this different. When I invest in real estate, number one, there's an address. I know where my money is. Number two, if I invest $100,000, let's equate this to shares to make it fair and equal to stocks. If I bought 1,000 shares of Apple and I bought 1,000 shares of real estate in a real estate investment, I can never lose my shares if I own that real estate. Even if the property burns to the ground, I still have the stake in the yard with the address. Now, there's one key difference. You can lose your basis, your 1,000 shares, if you're not in a first lien position, if you're in a position where you're over leveraged, and you're a 100% passive investor, and the sponsor does a really bad job, and the property goes back to the bank, it gets foreclosed on. Then you can lose your shares. But the benefits to real estate investing, in my opinion, is the tax advantages. I've never really heard too many people tell me things that I could apply to me by investing in 1,000 shares of stocks. Where real estate, like you said, I can depreciate it. I can use leverage. I can cost seg it. I can 1031 my way out of it. I can DST my way out of it. I don't see ways to make an exit in stocks, which is why I'm 100% real estate guy.
Yeah, and just for the sake of an objective argument, I will point out a couple avenues with stocks, but they tend to be a little bit more not going to work for most people, right? So that like you said, right? Whereas real estate it can work for a lot of people. So with stocks, a couple pathways is that you sell stocks that have an unrealized loss against ones that have a gain. So there's a little bit of a planning tool there, not anything crazy. And then another opportunity could be if you had appreciated stock, you maybe donate that stock. So now you get the charitable contribution at a higher value, and then you're kind of wiping out that appreciation that you'd be taxed on. But that doesn't fit for most people, right? So just for the sake of the conversation, yeah, with real estate, all the things you mentioned are very, very true. Tangible asset, so the depreciation concept, right? The tax benefits, but actually in most cases, the real estate actually appreciates, right? So getting this favorable asset that's appreciating, providing cash flow, all this goes down to buying the right deal, investing with someone that you trust and you understand what they're doing. But yeah, The underlying asset being real estate is very favorable for the reasons you described.
Now, in any one of the two cases, is there a concern about a step up in basis that causes a higher tax bracket?
So a step up in basis. So I guess just to touch on a little bit more what you mean there so I can answer correctly.
So say we buy 1,000 shares of Apple as, it was $100 a piece and it goes crazy. We're at $3,000 a piece. Is there a step up in basis? Like that $1,000 is way bigger now. Like that $1,000 or that 1,000 shares. Now we have this big step up in basis. We went from having $100,000 in stocks to $1 million in stocks.
Yeah, so what that really does is it's what they call a unrealized gain, meaning it's your stock is appreciated. Now, it really only gets triggered if you sell the shares. That's when the gain would be triggered. And that's why kind of in my example, maybe you donate that. Again, that's not going to work for a lot of people to basically say, hey, I don't want to get taxed on that appreciation. I am going to get a charitable donation value from it. Those have limitations as well. So yeah, that's kind of how that works, right? It appreciates as well, and then if you sell, you would then be taxed on the appreciation.
Absolutely. And I think for just the sake of keeping it simple, let's say everybody is going to make the most money when they sell, right? So you bought it for 100K, it went to 1 million, you want to sell this thing. Well, here's my biggest problem. This was the exact conversation of why I started to smile when I was being interviewed or tested by a full-on stockbroker professional. He's like, Eddie, but if you put $100,000 in, your shares, you go at $1 million basis, you can continue to trade these things and other assets and everything else. It's like, yeah, but I get my money back when I sell that asset. The problem is when I sell that, that's a taxable event. Like I'm triggering a tax. Like I have to, that's like you said, it's unrealized gains until I sell. Well, let's be honest. The only way to get your $1 million worth of value out is to sell.
Correct.
So if you sell and you're going to get taxed, that's where I'm like, I lean back in my chair, like, but if I have the exact same scenario happen, I bought a $100,000 property, done all the improvements, I got it entitled, and it's now worth $1 million. If I sell it, I can 1031 it tax free, or I could refinance it and I could put $700,000 in my pocket tax free.
Yep, exactly right. And that just goes back into this. These are things written into the tax code that make real estate more favorable. Yeah, the 1031 exchange is a huge one. Just to kind of touch on what that means, right? You sell real property, and instead of paying the tax on the gain, assuming it's appreciated in the time that you owned it, you then roll that into a new property. Rules and requirements around it, mainly around timing, to acquire your replacement and how that needs to be done. But yeah, it's a really great strategy. Defers the gain, so you're not paying tax when you sell. It carries over into that new property. And then there's even an opportunity to continue to do that until you pass, and then leave that to your heirs. And then they would get the step up in basis, where essentially it removes that gain. So that's a powerful strategy.
Yeah. I mean, and that's the thing where every time I was being, tested or like it was a fair assessment of an argument. And I'm like, okay, but great ride. Like I bought 1,000 shares. I had $100,000 invested. Apple went nuts. It went to $1 million. Great. But now I have a problem. My problem is, how do I exit? How do I get my money out? And that's the reason I love real estate, is it gives me that capability to move money through the market tax free and grow it. Plus I can use leverage. Like if a share is $1,000 a share, there's no way for me to buy at a smaller dollar amount, but I can with real estate. So if it's $100,000, I could put down $20,000 and I can still own the $100,000 real estate deal
And
with
a lot of
20
the
grand.
tax benefits are driven off the 100,000, not the 20K that you put down because of the ability to use leverage. Yeah, there's just a lot of favorable, um, things available on both the acquisition of real estate and using depreciation, and then a lot more flexibility with exit opportunities, 1031 exchanges, even doing refinancing and getting the money out that way. Um, there's a lot more flexibility.
Absolutely. So, what's the number one mistake you see people commonly make? There is this thing out there you got to watch for. It's called recapture. That's one you got to kind of watch your backside on, because you can get smacked around with that one. Again, it comes down to planning, right? So, if you are in a situation, I would imagine if you're going to sell a property, you're going to contact your CPA before you sell the property and say, hey, I'm going to take this much money, I'm going to put it over here. And you're probably going to go, you're not thinking about how much you put down, the improvements, and all this stuff. So pump the brakes.
Yeah, no, that's a really good point. And I would say, my answer kind of goes in line with what you said, right? Is not working with someone to help you do planning, because that goes back, that's a common scenario, right? Where you may be subject to recapture. And that's why, when I'm working with clients and we're discussing, hey, is this a good candidate for a cost segregation study? We would have that conversation now, because a lot of different people can be incentivized to push you in a direction without understanding your full picture, right? The cost segregation company, they may not know. They would like for you to do the study with them, but they may not have full insight to your situation. That's where a CPA can provide a lot of value, essentially being that quarterback to say, hey, yeah, move forward. This one's a good candidate, or no, remember we had that conversation and you're kind of short-term perspective on this one, or may need to get out of this. So it would just make it more difficult if you did cost segregation. And really, cost segregation is just the tool that allows you to accelerate depreciation. So that's just want to connect the dots there.
Absolutely. So I'm thinking throughout this conversation, there's really three triggers that everybody needs to just stop and go, I got to call CJ. I got to go call my CPA. So if you're going to buy, trade, or sell, you should contact your CPA. Or is there another category I'm missing?
Yeah, I think those are really three good triggers to say, hey, I need to talk to my CPA, or if you're not working with someone real estate focused, find someone, reach out to me. I'm happy to have a conversation. And then another one we get a lot is around entity structuring. So if you're have questions around that, or am I in the best structure? Again, we would look at it from a tax lens and a tax perspective. Your attorney would be the best to assess from a legal and asset protection standpoint. But our common planning would be, let's keep it simple, but also achieve your overall goal, not unnecessarily increase your tax reporting just for the sake of.
I dealt with this one personally. I structured a company off a corporation. Everything was fine and dandy. Brought on a partner. What we didn't realize until our bookkeeper was actually smart enough to say, hey, Eddie, now you have an issue. This was fine when you were a sole proprietor, but now that you have a partner, how are you going to do owner distributions and shares to the company? Because now you're essentially getting double taxed because of the current structure. So let's talk about that too. So if you're in a situation where you're running this business, but yet you're going to bring on a partner, there is certain corporate structures that are not beneficial for a partnership, correct?
Yeah, so you really want to just, it goes down to what are you trying to achieve? What is the activity, or what kind of investment, right? So, and then understanding what structure would be best. So, for example, active types of businesses, they're often great candidate for an S corporation. That is not the case with like buy and hold investment real estate. Those tend to be more favorable in a partnership structure. A lot of common scenarios you'll have where with partners, it's best to be in a partnership structure as opposed to another type of corporation, because it has more flexibility. You can write an operating agreement to achieve different things and allocate things differently. That can be achieved with that structure. Another downside of like an S corporation is it has to be pro rata, meaning if me and you are 50-50, everything has to be 50-50. Partnership, that has more flexibility. They are more complicated in that sense. The more creative you get with how it's structured, the more it takes, working with a bookkeeper that knows what you're doing, working with a CPA that can align with that. So just kind of keep that in mind.
Absolutely, because we didn't think about that. We were structured the best way we've seen fit to operate the way we're operating and not pay a lot of taxes. But when we brought a partner on that had a share of the company and we were going to start doing owner distributions, that triggered a whole different event. So again, maybe number 4. So just summarize here, guys. So if you're going to buy in a business or buy a property, contact your CPA with the money you're going to use. If you're going to trade something, whether you're going to trade stocks, you're going to trade real estate, you're going to do some type of a trade, contact your CPA. If you're going to sell, before you sell, and give your CPA plenty of time, please. They will appreciate you more. Hey, we're going to sell this thing in the next 3 to 6 months. What do we need to do? They're going to ask you the right question. And the last thing is if you're having a change or you're setting up a new corporation, reach out to your CPA and let them do that evaluation. Because, guys, I don't like paying taxes. End of story. I don't like doing it. I mean, you got to pay Caesar what Caesar's supposed to be paid. But at the end of the day, there is clear, clean, concise tax laws that we can abide by. And hire somebody smarter than you, get a CPA, and have that CPA do the work that they are good at.
Yeah, great point. There's a lot of tax strategies and benefits out there. With like social media and things like that, there is like an oversimplification of like tax strategy and some misleading information, some good information as a starting point. I think it's best, finding someone that's a good fit for you, have them dive into your situation. And a lot of the key is just making sure that you have the right plan in place and then following that plan. A lot of it goes along with documenting the things you need to do to achieve that result and having that done in a format to where if it is ever challenged, it's a matter of just presenting that and say, hey, this is why I took this position. It's all very well documented and buttoned up. If you don't do that, that's where you run into problems where, hey, I took a position that I can't substantiate. And now it's a stressful audit situation.
Absolutely. Man, this has been a great podcast, tons of insights. I'm going to move into the fire round. I want to ask you 3 questions. Just fire them off the top of your head. What is the best book you've ever read?
Best book I've ever read. What comes to mind actually is a book maybe not everyone has heard of. It's called The Wealthy Gardener. I read that early on into just financial literacy, and that kind of gave me the blueprint around how I thought about not only wealth, but like happiness along with that.
Awesome. Go check that one out, guys. I'm going to put it on my list too. Favorite motivational quote?
Favorite motivational quote. Let's see. I don't know why this one comes to mind, but kind of cliche, but you miss 100% of the shots you don't take. Probably because my son is playing basketball right now and just mentioned that one to me, but I think it's a good one, just
Oh,
off the
yeah.
top of my head.
Truth, man. So true. We're going to get a little deeper on this one afterwards, but how are you using AI in your daily life to improve lifestyle or workload?
Yeah, I think my framework right now is just anything I'm doing, can AI somehow be implemented in what I'm doing? Can I be more efficient with what I'm doing right now? Somehow leveraging AI. How that looks for me specifically is there's even some like tax research tools. A lot of in the tax space, it's kind of in progress. It's not there yet, but it is sped up our ability to provide analysis instead of it's made it faster to reach the code sections and things that we need to read through and verify, especially for the more complicated situations. So I would say that that's kind of how I'm utilizing it right now.
Awesome. Do you feel like AI will disrupt bookkeeping and CPAs as AI evolves and gets smarter?
I think it will disrupt most things, including bookkeepers and accountants that provide some of the services that more traditionally have been done, right? Like, so maybe like basic bookkeeping, basic tax preparation. I think it will disrupt that. And I think that's probably closer than we think. I think it'll be very difficult to replace the more outside the box critical thinking. Even some of like the real estate bookkeeping, it's so not straightforward. It's not standard. Every deal is different, and closing statements vary. And so I think it's going to be hard to really get that to be systematically done. And then some of the like more advanced tax planning, I think it's going to be trouble. I think because it comes back to a lot of what I said, where it really just takes knowing all the details about you and your situation. And AI to this point really is only as good as the information you give it and you feed it and the inputs you give it. If you leave out a key detail, it could change the entire scenario. So I test a lot of like tax scenarios in there just to see what kind of results. And if you lead, you can intentionally kind of lead it to where you want it to go if you don't give it all of the facts.
I think you said it right there. We could manipulate the AI systems to get the outcome we're looking for because AI has the capacity to lean that way. But yet, CJ, he knows what he knows. He knows the tax laws. And if he cares about me, he's not going to get me in trouble. So even though I might try to be manipulating CJ into agreeing with me that we can write off 100%, CJ is going to go, no, we can't because of this reason. And we're not going to get audited. So I think that's the magic thing, guys, is we have to think about AI will disrupt bookkeeping at the basic level. But when it comes to like really building relationships, I want to know that CJ will argue with me. I want to know that CJ is going to be like, no, I'm sorry, Eddie, we can't do that by the way you structured it, by the way you sold it. No, it won't work.
Or more
Well,
importantly, saying, here's what would need to be true to have that result, right? Maybe not always no, 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 but no, given that fact pattern, but here's what would need to be true. And then is it practical or feasible to have it be that way? Sometimes it's not, right? Sometimes, hey, it's just not, that's not possible, or it's not practical. And we have to go with the way we're currently doing it.
like calling you up saying, CJ, why am I paying all these taxes? Because you didn't contact me 30 days before you sold it. That's why, because we could have changed things before, but you proceeded without calling me first.
Always more value we can add on the front end. So 100%. Yeah.
CJ, where can people find you, buddy?
Yeah, so on social media, CJ the CPA, we post a lot of educational content and things we're working on with clients. If you are interested in speaking with me and having me look at your situation, you can go to my website. I'm sure we can put a link to that in the notes. And then, yeah, we do a discovery call, dive into your situation, ask you some questions, get some documents from you, and then see if we're a good fit to help you, and at least provide some value on that call. So those are the two pathways.
Beautiful. Thank you so much. You've been an amazing guest. Listeners, please, we can see that you are watching. The problem is you're not subscribed and the channel doesn't grow unless you're subscribed. So please, by all means, help us out. Hit the like button and smash that subscribe button. And if you want to stay up to date, make sure you hit the notification bell. We'll see you on the next episode. Thank you all so much.